Utah Housing Corporation can give you 6% of the purchase price for your first home, but it might cost you the first year or two of your equity. So do you do it? Do you give up potentially $26,000 to get into your first home? Stick around to see where those 2 years of equity go and find out how you lose $26,000. First, I'm going to talk about the 5 grooves that you want in your key to get into your first home. If you've ever looked at a key, you've probably noticed that it's got grooves. I'm going to tell you about the 5 grooves that you want to put in your key to help you get into your very first home. Exploring the options to get into a home means talking mostly about how to come up with a down payment, how to come up with a key, down payment assistance, first-time buyer programs, 401k loans from yourself to yourself, selling your favorite NFTs off, or cars, or Persian rugs, or baseball cards, whatever it is that you have that's worth anything. And of course, and maybe potentially my favorite, gifts. Gifts are a great way to come up with a down payment quickly. In 2008, I was laid off right as I was about to buy my first home. You're probably like me and you've watched home prices double since the pandemic started. Every year, it seems like there's one more obstacle making it harder to get that key. More expensive, more difficult. It's always finding that down payment that proves to be the hardest thing. But what if I had bought a home right before the financial crash? Everyone at the time was talking about how overvalued homes were in 2008, how sellers were getting everything they want, and prices were so high, and buyers were crazy. And maybe that sounds a little familiar to you right now. So where would I be if I hadn't been laid off and I had bought a home instead? If my income stayed dependable and I bought an excellent home in the Avenues University area for $369,000, which is a really great home in the Avenues or University area in 2008. 369 is a little bit above average, but it's still in that range of average. The average mortgage rate at the time was 6%. If I made a 5% down payment towards that home, the mortgage would have been about $2,600. To make this more accurate, I'll base this on a real home with actual numbers, one that sold for $369,000 in 2008. It's impossible to anticipate when there will be years of 20 or 30% appreciation, but the average yearly appreciation since 2000 has been 5.70% for Utah. Even then, that's pretty conservative. Before the pandemic, the average was closer to 10% for the last 10 years. Probably I would have refinanced when interest rates were available for 2% in 2019 or 2020. We may never see interest rates so low again in our lifetimes. But let's say that I sold the home in 2021 for $780,000, which is what it sold for in 2021. That puts me at $411,000 appreciation in 12 years. 111% appreciation in 12 years is not bad, especially when you consider that the alternative is paying rent and not capturing any appreciation or equity or tax benefits at all. But to say that I've only made 111% back is to miss the fact that I only put 5% down on the purchase. I've actually increased my $18,450 or 5% by 22.28 times. There are costs to owning a home, but no doubt that $411,000 dwarfs any costs incurred. So, to get that $18,450 or 5%, it helps my motivation to know that I can increase it by $392,550 in 12 years just by living in that excellent home in the Avenues or University area that I wanted to live in anyway. In this scenario, where I stand to increase my wealth by $411,000 passively, I'm going to do whatever I can to find this money. There are dozens of creative ways to find money. Some of them are lucrative, like wrapping your car as a billboard for $400 a month. Others help more around the edges, like relying on do-it-yourself solutions for maintenance around the house, or your clothes, or cleaning supplies. Most mortgage companies have a good list of suggestions online. American Pacific Mortgage has a good list of 21 ways, including the ones I just mentioned. Generally, they run from the gamut from becoming a freelancer to increasing your earnings by monetizing your hobbies and passions. At the other end of the spectrum, you have tightening your financial belt. You can sell anything of worth that you own, from NFTs to Persian rugs to cars to baseball cards, like I mentioned earlier. You could drive for rideshare companies, or try to sell found treasures from thrift stores or garage sales. Most of the money-saving options include some form of automation in your savings, like putting your tax refund into your savings and doing away with any subscriptions that you don't use anymore. The fact of tracking spending can reveal places where SaaS, or software as services, have crept into your subscriptions and you no longer use them. Ultimately, the most efficient and effective way to put a down payment together is in the form of gifts from family or friends, and if you have friends like that, I envy you. If your family has generational wealth, there's almost no faster way to find a down payment, and you shouldn't be shy to ask for help. That leaves loans from yourself to yourself from your retirement account. The rules on how this program work are specific to every fund, but there are some general principles at work. You can either borrow or withdraw funds from your retirement. There are slightly different rules for a withdrawal that include paying taxes and a 10% penalty for those younger than 59 and a half years old. Borrowing the funds means that you're acting as a bank and will pay yourself interest, usually due within 5 years. According to the Utah Housing Corporation, they were created in 1975 by Utah legislation to serve a public purpose in creating an adequate supply of money with which mortgage loans at reasonable interest rates could be made to help provide affordable housing for low and moderate income persons. It's a bit of a run-on sentence, but it comes straight from the Utah Housing Corporation website. The Utah Housing Corporation, or UHC, is the masthead for down payment assistance and first-time buyer programs. There are others, and most lenders have their own, but UHC's special mission is to provide assistance loans. There are 3 programs with UHC: First Home, Home Again, and Score. You can get 6% of the purchase price of the home you want with no money down. The 6% advance can cover your down payment and your closing costs and will be a second mortgage on top of the first mortgage. If you've tapped out your maximum earning potential, sold every asset imaginable, including your car, and don't have any gifts, UHC is a good option for a borrower to get into a first home. With a conventional loan, there's a maximum loan to value ratio where the loan does not exceed 95% of the home value. This prevents the borrower from being upside down on the loan. UHC exceeds the 95% loan to value because you need 3.5% down payment for the FHA loan, approximately 2.5% for the closing costs, 1.75% upfront mortgage insurance, as well as the regular 0.85% mortgage insurance. That adds up to 103.6% loan to value. So starting out with the UHC mortgage, the homebuyer is already upside down. If you don't have an option, and you know you aren't going to lose your income or need to sell the home in those first year or two, a UHC mortgage can get you into your first home. Today, the average price for a home is much closer to $600,000 than $300,000. That means taking out almost $22,000 more than the home is worth to get into your home. Could be more if you spent more than $600,000. Obviously, you'll want to do the math with your lender to see what your best options are. But if there's any way that you can scrape a down payment together for a home, it might be better to take the option that's not UHC. There are times when it'll be the only option, and I'm glad it exists for that reason. Did you catch the 5 grooves in the key? Number 1, down payment assistance, first-time buyer programs, finding assets wherever you can by selling your things, finding money by monetizing your hobbies or saving money. Number 5, the very best, my most favorite, gifts. Gifts are the biggest notch in the key. Watch my video about first-time homebuyer mistakes so you can avoid making costly mistakes when you're just getting started building your wealth. I'm Ryan Shupit with Active Utah Homes at Realty One Group Signature. On this channel, I teach you everything you need to know about buying your first home.